Welcome back to the IT Investor Podcast, the show where we help tech professionals think clearly about building wealth beyond their W 2 income. I'm Pramod, joined as always by my co host, Wally.
Good to be here. And today's topic might not sound flashy, but it's one of the most important conversations we investors need to have.
Yes, Wally. And today we are talking about risk management, not returns, not upside projections, but what actually protects your capital when things go south.
Yeah, real estate is a risky business and problems will happen. It becomes risky when a deal isn't built to survive those problems.
Yeah, that's right, Wally. And our webinar presentations, what I have noticed is most investors start by asking one question, right? What is the return? But whereas experienced investors start somewhere else, they question what breaks if something goes wrong.
Yeah, it's so true. Especially newer investors, they just want to know what's my return going to be? How much money am I going to make on this deal? But it really is important to pay attention to what happens if things don't go perfectly. Those questions will change. Will change everything. You know, any GP partner out there can present to you this perfect model of a perfect scenario, but um, not a lot of them are going to tell you how a deal will perform underneath some stress.
Yeah, and exactly we could correlate this to our tech buddies. So in tech, this should be familiar with you. Now, we don't deploy software assuming that there will be zero bugs, right?
Yeah, 100% agree, Pramod. You don't assume uh, that everything's going to go perfectly. You assume things are going to fail, and you design your systems for that.
Yeah. And real estate also works the same way. So you're not trying to avoid problems, but you're making sure problems are survivable actually. And it's the preparation or the planning, how you navigate through these waters.
Yeah, 100% agree, Pramod. And we have different layers of protection for this risk management. The very first and foremost important layer is insurance. And this isn't just a checkbox we check, it's risk transfer.
Yeah, right. And insurance exists, so you're not personally carrying risks, and you don't need to. When we talk about insurance, Wally, we are really talking about a few protections. Do you mind going over those?
Yeah, the first is property insurance. That's the protection of the physical asset itself.
Yeah, and this property insurance protects the property from fire, storms, major damages. And if something happens to the building, this is what lets you repair or rebuild instead of writing a massive check.
Yeah, you don't want to be cutting those checks to repair or replace buildings. It just takes one bad event and erase years of your progress on a project.
Yeah. And the second one, Wally, is general liability. So if someone slips or falls or gets hurt on the property and decides to sue, this coverage steps in.
Yeah, we see those commercials all the time on TV, right? Accident injury lawyers, right? Everybody out there is trying to sue to make a quick buck. Those lawsuits, they get really expensive. I mean, even if you as the property owner, you didn't do anything wrong.
Right, right. Yeah. Now let's look at the third, which is the loss of rents or the business interruption. Now, if units can't be occupied after a damage, let's say a fire or a storm, and the unit is getting rehabbed. So during this time, if you have this protection, the loss of rent, you will be protected while repairs are happening.
Interesting. Pramod, you were sharing a story earlier. We were talking about an instance where you used this type of insurance for one of your properties.
Yes. So 2 years ago, when we bought the property in Portsmouth, after 3 or 4 months, basically, we had a water issue where a tenant on the second floor left his kitchen sink open, like a slight open, and for some reason it flooded in the morning. And eventually the roof collapsed, actually. Um, and we had to move the downstairs tenant to another unit. Luckily, we had a vacant unit, so we were able to move him. But what basically happened is it took us some time, maybe 2 weeks, to file the insurance claim and to get the repairs done. And luckily, we had the protection against loss of rent, so that 1 month was covered. And we also did have the first insurance, right? The first layer, which is the property insurance. So we were covered for the repairs. And that's how we used both of those layers in this case.
That's awesome. So the unit below the roof collapsed on the tenant while unit was occupied, and you had to move them out into another unit.
Yeah.
And the loss of rents insurance covered
Yeah.
rent on unit that was being repaired. Huh.
The good thing is nobody got hurt. The roof collapsed in the kitchen, not in the bedroom where the tenants were sleeping, luckily. Otherwise,
Lucky guy using all three of yours.
we would have to use all the three, right? Yeah.
So is that loss of rents or the business interruption insurance, is that an expensive insurance to carry?
I don't think so. It was quite expensive. As I mean, when you're taking quotes from insurance companies, they quote for each of the line item, right? And they also tell you like this is needed. I mean, since you are in this business of commercial or multifamily, it is in your best interest to definitely carry that, and it wasn't that expensive, I will say.
Yeah, that's interesting. I mean, insurance can be one of your bigger expenses when you own a piece of commercial real estate. And I could see places where an investor might want to cut corners, and
Right.
this is not an insurance that you want to cut. I mean, business expenses and loan payments don't just stop just because your tenant isn't paying rent on a unit they had to move out of to make a repair.
hmm Yeah, and finally, Wally, let's look at another coverage, which is the umbrella coverage. This is for protecting low probability but high impact events.
Yeah, umbrella coverage is really important. You're not expecting trouble, but in that one extreme event that could just totally trash your deal, this umbrella coverage will protect you against pretty much anything that your other insurances aren't going to cover.
Yeah, all in all, insurance doesn't eliminate risk. It keeps one bad day from becoming a bad decade, Wally.
Yeah, absolutely.
Yeah.
Talk a little bit about layer number two, which is our reserves.
Yes. So the next layer of risk management is the reserves. If insurance is your seatbelt, reserves are considered your airbags.
I like that analogy. And airbags, they're not exactly exciting, but they can be the difference between a calm decision and making a panic decision.
Yeah. And reserves are really categorized into different buckets of cash with different jobs. So let's look at them. The first is the operating reserves, Wally. And this covers the normal expenses if cash flow dips. And the normal expenses are generally like the operating expenses, which are like the property maintenance or the property management, the utility payroll.
Yeah, this operating reserve, it will keep small problems from becoming urgent problems later.
Correct, correct. And the second one is the capex reserves. These are for the big ticket items that you got to plan, which is like putting a new roof or getting new HVACs, redoing the parking lots or any renovations.
Yeah, this is a big one too. I know in the last few capital raises I've done with one of the syndicators I work with, like we intentionally raise capex funds as part of that initial raise as we're closing that deal. We want to make sure that there is money in place to do some of those unit renovations, like you mentioned, the roofs. A lot of times if you're buying an older vintage property, you need to put new roofs on the buildings. HVACs are like you mentioned, they're always causing problems, especially in areas where you've got extreme heat or extreme
Yeah.
cold. And these are just things that you know that are eventually going to come in the lifetime of owning that property.
Yeah. And some of these, let's say, like if somebody is coming new or new to multifamily and they are trying to own, for them, this piece of advice could be valuable. Some of these expenses can be planned and some can be unplanned. What I mean by that is the planned expenses are like when you buy a property, you look at the condition of the property. Say if the roof is bad, you have to plan for that roof. But there are some unplanned events which can occur like in summer, some of the HVACs, they just go bad and you have got to replace. And those are not cheap either, right? Each HVAC costs like 5 or 7 grand. So it's a big expense. And in winters, the same, I mean, to heat the apartments, we use the furnaces. So it can be a gas furnace or electric furnace. And in any season, water heaters, right? Those can go wrong or those need to be replaced. So these are all unplanned and could go wrong anytime.
Yeah, I was just going to say, you make a great point, Pramod. And that's the point of reserves, right? You're planning to have funds in place for when something does go wrong and you're not panicking to scramble to find the capital to make those repairs.
Yeah, exactly. Now, Wally, let's look at the third category, which is the service buffers. This is needed cash specifically to cover loan payments if income temporarily falls short.
Yeah, the debt service buffer protects the property and it protects your investors. By having this in place, it keeps you from having to make a forced decision about having to foreclose or sell on a property.
Yeah. And Unfortunately, Wally, reserves don't boost returns on a spreadsheet, but they give the deal breathing room.
Yeah, and that breathing room is what allows smart decisions instead of having to make some of those rush decisions. I'll share an example too. But one of the properties I invested in with the syndicator I work with, we're at about the 14th or the 16th month of the hold so far. And that first year, they were paying investors their monthly
Dividends?
rents, yeah, the dividend. And we're at the point now where after the first year, they projected to increase rents and increase that dividend pay to the investors. And we've seen in the last year, like market rents across the United States really haven't increased too much. And what this indicator has done is they actually have a capital bucket, and I forget what they called it, but they're now paying that increase in dividends, even though rent hasn't gone up, because they set aside money just in case the market didn't do what they projected it to do, so that they could still keep investors happy in the deal. Which I think that's pretty savvy planning right there.
Yeah, yeah, yeah. I agree.
Yeah. So let's talk about structural downside protection for a minute. This
Okay.
is the layer that most people don't think about up front. It's actually how you structured your deal.
Yeah. So basically, this is needed when things don't go perfectly. The real question isn't how bad does this get? So one should ask, can this deal survive?
Yeah. Pramod, can you give us a quick example?
Yeah, sure, Wally. So on a well structured deal, even if vacancy jumps to 30%, the property can still break even rents and cover expenses and debt service.
Yeah, that's huge. If you're breaking even, you're not panicking, right? You've got time to fix operations and wait for the demand to return.
Yeah, exactly. And it's the same idea with the expenses. So if insurance or taxes or payroll or any of these operating costs jump, say, by 15%, hurts, but the property still stands.
Yeah. If you have some of those assumptions kind of built into your model, even if things don't stay perfect forever, you'll still survive with those unexpected jumps in costs.
Yeah. And on another note, if you have a floating interest rate debt on the property, if the rates reset higher by, say, 200 or 300 basis points, the returns shrink, but the operations still work if you plan.
Yeah, yeah, you're definitely not going to be celebrating those floating point interest rates as they increase on you. But if you've prepared for it, you're not forced to sell at a wrong time that puts you or your investors in a bad position.
Yeah. And this is the downside protection and not avoiding hits, but absorbing them. And you continue to move forward with a plan. So, Wally, why this resonates with IT professionals, right? This mindset clicks the same for people in tech.
Yeah, absolutely, Pramod. You don't always judge your system by like its peak performance. You especially as data engineers judge by how things happen when something fails.
Exactly. I mean, returns are the output, and risk management is the architecture underneath it.
Yeah, agreed. When you're looking at properties or something to invest in, operators out there, they can show you pro forma, but not everybody is going to show you how well a deal is going to survive when some of these stressors come into play.
Yeah, long term wealth isn't built by chasing the biggest numbers, but it's built by staying in the game long enough for compounding to work.
Yeah, 100% agree, Pramod. Those upsides, they get the headlines, but survival is where you'll truly create and protect your wealth.
Yeah. Thanks for listening to the IT podcast. If this episode helped you to think differently about risk, share it with someone evaluating their next investment.
All right, we'll see you next time.
Thank you.